Welcome everyone, and thank you for joining our webinar this morning. My name is Kim Kellaway and I'm Head of Clients and Markets at HLB Mann Judd and will be your moderator for this morning. Today we are presenting Managing Personal Finances During Uncertain Times. Our presentation will run for approximately 30 to 40 minutes, and at which time we will open up for Q&A. I encourage you to type your questions into the Q&A box in your Zoom control panel during the presentation, and our panellists will then answer the questions during that time. So I would like to introduce you to our panellists today. Good morning, Michael, and good morning, Jonathan.
Good morning, Kim. Morning, everyone.
We have a number of guests as well as clients joining us today. So I thought it'd be nice if you just shared a little bit about yourselves and your history with HLB Mann Judd. Over to you, Michael.
Yeah, thanks, Kim. So I joined Mann Judd many years ago from university. Some would say many, many years ago. But over that time, I've seen the firm diversify, I've seen the firm grow, and I've seen the firm get into specific areas. And a good example of that would be the wealth division that we established 20 years ago. I really enjoy the interaction with clients in dealing in the wealth space. I get to talk with people about investments, tax planning, estate planning, retirement planning, superannuation, all that good stuff. And that's very interesting for me to be involved in this. And I have a particular interest in the machinations of family business, and often find myself talking to business owners about things such as how to make themselves financially independent, but financially independent of their business. So anyway, that's the sort of thing that we tend to discuss.
And Jonathan?
Yes, I've been at HLB now for 25 years. I was lucky enough, Michael gave me a job when he was starting up the superannuation division. And then we started wealth management up in of course, 99. So I do the same as what Michael's doing. And, I guess if I could put in a quick 30-second ad for us, I think where we differentiate ourselves with our advice compared to other, say, the banks and smaller advisory firms is that, for our clients, we're really able to provide pretty much all their personal financial needs in the one place. Whether it's their accounting, tax, their wealth, superannuation, insurances, estate planning, and debts, our latest area. Having specialists in each of those areas that's able to work for a client, but all in the one place. I think it saves our clients having to tell their story, to 4 or 5, different people at different places and having to coordinate all of that. So I think that's probably one of our biggest advantages. Just something a little bit sort of about me. What I've learned about myself through this period is that I'm very glad I actually chose the career that I did. I can put up with the 5% daily movements in the markets, but trying to homeschool. I don't know whether you can see these 2 little tigers behind me there. I found that a very challenging period of our lives. So I guess I've got now even greater respect for the teachers and the fantastic job that they do, but certainly couldn't have done it.
Okay, thank you, Jono. 25 years, you must have been 5 when you started.
I did. That's probably I missed too much school. That was probably the problem.
This is our disclaimer. This webinar is general advice only and relates to individuals. So let us set the scene and the discussion for our panellists today. And I'd like to ask our first polling question. So our first question is, are you feeling anxious about your finances? Yes, no, or unsure? Would you like to start polling for me, please? Thank you everyone for that. So I'm now going to share our results with you all. So as we can see, 37% said yes, 35% said no, and 27% was unsure. So this is a great segue to refer to our panelists, as this is certainly top of mind for many of us. So Jonathan, would you like to comment on those percentages, please?
Yeah, sure. Look, probably I thought perhaps it might be a few more people a little bit more anxious with what's been going on. But perhaps you've all been very good and blocked out a lot of the noise that has been obviously out in the media every day and so forth, with all the 24-hour news cycles. And the keys through this period is just how does it affect you, you know? And I guess for many people that are 10, 15 years away from retiring and that sort of thing, this really isn't going to have a great impact on your finances in the long term. Yes, if you were looking, say, at finishing up work in the next year or so, it obviously will have a bigger impact, and then it's, you know, well, what is it that you can do? What is it, you know, are you in already a sufficient financial position to still continue with your plans, or do you need to alter them, work longer or something like that? And obviously that's where you perhaps need to get some good advice with it all. But you know, it's always with this period there, it's a lot of uncertainty that we have, and the simple answer is that no one knows what will occur in the future. But really, you know, as I said, the key is just how does it actually impact your personal plans at all?
Thank you, Jonathan. So I think we'll start our questions for our panelists, and I'll go back to you now, Jonathan. So can you talk us through what has happened to the markets since the COVID-19 crisis has begun?
Yes, so obviously it's been a very difficult period, and you know, the Australian share market really has never experienced anything like this before. Nearly 40% fall in a 1 month period. The ASX 200, it hit 7,197 points on the 21st of February. It fell all the way down to 4,402 on the 23rd of March. As shown on this graph here, the falls were actually, the purple bars on the graph show the falls both in Australia and all around the world there. So you'll see basically 35 to 40% sort of falls occurred globally, and all basically around that same sort of period there, late February through to that late March period there. And it was obviously reflecting a health crisis that shut the world economy. And until there's some sort of health solution, we really don't have a way that we can, with certainty, move forward with it all. And there's obviously been a lot of chat about, talk first of all started about a V-shaped sort of recovery, which simply means that it was, you know, it was a sharp fall, but it also, things bounce back pretty quickly and things recover and everything opens back up again. And that's this V-shaped sort of recovery. And then more talk started being about a W-shaped sort of recovery. So this is more about a second wave coming through. So everything will shut down again, and then we've got to recover from that again. It may well be a worse sort of recovery where it just keeps going on for a number of years. We really just don't know how long it will all be until, as I said, until we're more certain on the health side of things with it all. But what we have seen, obviously, through this period is that the share markets actually bounced quite back sharply, and the ASX 200 today is back up approaching 6,000 points, and that's 35% bounce back off those lows in late March. And this is shown here on the red lines on this graph here. So you'll see that the Australian share market, even though we've bounced back quite a long way, 35%, we're still down about 17% off that peak value back in late February. Probably what surprises me the most with share markets, the way they've bounced back, has been the US share market. And we're still obviously receiving reports from some of the states over in the US where they've got record new daily cases of the COVID virus affecting them. Yet their market's nearly back to where it was. And in fact, some sectors and some stocks are at all-time highs. And it's really being driven by their tech sector over there. You may have heard of their FANG stocks, the Facebook, Apple, Amazon, Netflix, and Google. Some of them are now hitting all-time highs. And I guess this investment theme of tech platforms, more online purchasing going on, it's really been fast-tracked through this period here. It's occurring as well in Australia, but our tech sector is a much smaller part of our market. But the big US global tech stocks, they've really led the way back out of this current period.
Now we've got a question, Jono, in regards to that slide. I noticed China hasn't fallen or hasn't been mapped. Is there any reason for that?
Well, it is part of the Asia index, MSCI Asia, on the market there. We didn't put the slide. This is a perpetual slide there. It is a fairly large portion. I can't remember the exact numbers of it, but the China numbers. They had their market probably fell a little bit earlier than the other markets around the world, but again on their share markets bounced back pretty strongly as well. Yeah.
Okay. So I'm now going to ask Michael, what should investors be doing now, both short and long term?
Yeah, it's a interesting question, Kim. But I think the best thing for investors to do is take a long-term view if they can afford to. And in that category, I'd put people who are retired, people who are recently retired, people who are approaching retirement, and then certainly your 40-year-olds and younger. But people who are just approaching retirement, I mean, they've still got a long-term time view in my book. Retirement can be a very long time these days. People are retiring at 65, they might be dying at 90 or whatever. So they can still have a very long-term view with their investments. And markets are going to be volatile in the short term. Like as John has pointed out on this slide, they're massive drops very quickly, but then there's also pretty quick rebounds happening. And so in the short term, it's very difficult we can't predict what the markets are going to do, but in the long term, say 10 years or say 7-10 years plus, markets are much more stable. They have a much steadier path upwards. So certainly take a long-term view if you can afford to. If you do need short-term cash or short-term expense obligations, such as purchasing a property or even having cash available to pay pension payments out of your superannuation or a monthly stipend from your investment portfolio, whatever, do have cash available to cover short-term needs, and also have an appropriately weighted portfolio. And so well-structured portfolio would have I believe would have a chunk of money in fairly secure sort of investments, and that provides some stability and bolstering during the times that are reflected on this slide, but also have an appropriate allocation to longer term assets, longer term volatile growth style assets that are going to give you a return, hopefully over and above inflation in that longer term time period. And the thing is to have a good investment strategy, good quality investments, and then stick to it. It might sound a bit boring, but the chop and change can be very, very damaging to somebody's wealth.
So, Jonathan, what are the long-term return assumptions for share and fixed interest returns?
Okay, yeah. So I've put up a bit of a complicated looking slide there that shows our actual 10-year forecasts for the share markets around the world, and also includes our average expected return for term deposits for the next 10 years as well. So we work with an independent asset consultant on a quarterly basis to work through these 10-year forecast returns for the share markets, and we do that on a quarterly basis. But it's the numbers, the adjustment to the numbers usually are only very, very small when we're working through it. What we make very clear, but is that these are 10-year forecast returns. They're not 6 month, they're not 1 year, they're not even 3-year predictions. As we've seen, what's happened this year already, you can't predict what occurs in the markets over short-term periods. You can, in fact, predict what markets should do over longer periods of time. That's when we're talking about 10-year sort of periods, because it takes the impact of the crises right out of it and just then focuses back more on the fundamentals, such as, what's the dividend yield and what's economic growth and all these sorts of key drivers to share markets over longer periods of time there. And I think that's a far safer way to work with when you're building sort of portfolios and basically determining your overall asset allocation, to work on these sorts of numbers there. So breaking it up, there's 3 components to our returns there. It's a dividend yield, it's the earnings per share growth, and the last one, PE change, is just simply our valuation on the markets. So if a market was expensive at the moment, we'd expect that over a 10-year period of time, it would get back to a sort of more normal level. And on this chart here, you can see with the US numbers there, where the PE change for them is negative 1.6%. So that's reflecting our views that at the moment the US market is in expensive sort of territory, and that over a 10-year period, would expect that it would take about 1.6% per annum off that return as their market gets back to a sort of more normal sort of PE level there. So look, I'll start with the Australian share market, and so our long-term expected return, you'll see there is 7.8%, so close to 8% per annum. We expect the Aussie share market to do over the next 10 years. Now, as I said, that's not going to happen every single year, and who knows what it ends up being for this year's sort of thing. But what it gives us a fairly good idea is that over a 10-year period, we're probably going to average about an 8% per annum return for the Aussie market. Now, a large portion of that is made up of our dividend yield. That's sitting up at 5.5%, and that includes franking credits. It's probably a key reason why the Australian share market has traditionally paid out such a high level of dividends as compared to other global share markets. The fact that we have franking credits included with our dividends. But you'll see there, fairly high dividend yield, and then a little bit of earnings per share growth and a little bit of the an increase in our market comes us to about an 8% sort of return. When we compare that then to the United States, the US market, that only now sits at 2.2%. So the Australian market actually looks pretty good compared to our US market outlook there. And that's really reversing what has occurred over the last 10 years with the market. So since the GFC, it's been the US market that's been by far the strongest performing market on a global basis. Probably outperforming all the other markets around the world by about 5 to 6% per annum over this last 10-year period there. But we're kind of saying, look, we think that's going to reverse, and it's amazing how cyclical markets really are over longer periods of time there. You tend to see that one market that performs really strong for a long period of time will then be the underperformer for the next 10 years sort of period there. So that's obviously what we're saying with the US market there. You'll see Europe, again, that looks pretty strong. That's sitting up to close to 10% per annum sort of return, and Asia is sitting similar to Australia around that 8% sort of return there. So basically global share markets, apart from the US market, all sit around a fairly strong sort of level around 8 to 10% sort of range there, which is pretty good for a share market return there. Particularly when you compare it to that term deposit rate of 1.5%, which we expect over the next 10-year period there. The Reserve Bank's already said they won't be increasing rates for the next 3 years. They've got it locked in at 0.25% just to give the business some certainty that interest rates will remain low. And obviously global banks have all said interest rates will not be rising for a long period of time there. So we know that interest rates will stay low. since the GFC, this has probably been the biggest change in markets. Not so much what the share markets have done, because if you'd stayed invested in the shares through this period there, the returns you've come out with haven't been too bad. What's really hurt has been investors that have just have been cautious and have just pretty much stayed in term deposit type of investments. They've seen their return fall from this average of about a 4% long-term term deposit rate now down to 1.5%. Potentially that may even fall even further. And that's probably been the biggest impact post GFC, that the poor returns that's now coming out of this secure part of the portfolio there. We're very much in a low interest rate environment, which will stay that way for quite a while.
So Jonathan, on that slide, it's interesting to see Europe at the highest forecast returns. One of our attorneys has said they've never considered Europe as being the leader in yield based on how we are trained to read on the States and now Asia leading the way. What's the reason for Europe being ahead of the game?
Well, the biggest thing with Europe is that and obviously they've got a hell of a health crisis going on over there as well, and you know, with a number of other issues that they've had going on with the whole you know, not really a strong, stable Eurozone area there. But they do have they pay dividends. That's one thing. So they're as you see there, their dividend yield is certainly stronger than the US market, and sits around that. That's fairly stable for them. That dividend yield around that 3% sort of level there. Look, earnings per share growth is not a great number there. It's only 2%, so it's not a lot of growth actually coming through. But the key thing probably for the European markets is that if you had a look at the PE of their markets, they're in what we call cheap sort of territory there. They're most of them would be low, you know, 10 to sort of 13 PE range on a lot of their share markets. And for Europe, that should move up close to about sort of a 17 or 18 PE range over the long term. Not saying this will happen. I don't think it'll happen anytime soon in Europe. But over time, particularly in a low interest rate environment, you just expect people to pay a little bit more for shares. So, yeah, look, it's a little bit more attractive than Australia and Asia, but yeah, it's similar sort of figures there.
Thank you. So, Michael, can we use past market corrections as a guide for how long it takes to recover?
Yeah, I don't know. I guess we can take it as a guide, and as John has already pointed out, we already do seem to have had quite a correction, or quite a bounce back from the correction, but who knows whether we are going to get that V shape. It's sort of looking like that at the moment, or whether it'll be a W, or I think as Jono said, a WWW. Who knows where it can go from here? Like with the global financial crisis there on the slide, it actually took us about 12 years to get back to for the Australian market index to get back to where it was back in 2007, 2008. So that was a 12-year bounce back. But the thing is, when you do include dividends, it's still a long time, but it only took 6 years to get back when you think about the dividends that the market has produced as well. The tech wreck there in 2001, that took about 3 years to get back. And the 87 crash was another beauty. That was negative 50%. That took about 6.5 years to get back from that one, although about 5.5 years when dividends are included. So I guess the point of this slide is that it shows that the market always does get back up and over previous highs. And that's on the basis that the global economy is growing, people's living standards are improving, and in the fullness of time, markets do always get back to their previous high and then go onwards. There's always something happening. You know, there's all the things pointed out there, but then we've also had your Brexits, we've had the US-China trade wars, we've had oil price deflations, and now, you know, with the COVID-19 pandemic, has caused another shock to investment markets. But I did look, when I look at a fairly typical client portfolio that's well balanced, it's well invested, well diversified. I've seen that from 31 December until today, it's down about 3%. And so Jono's slide earlier where it said the Australian market's still got a long way to go to get back to its heights at sort of mid-February. If we take 31 December as a line in the sand, you know, the portfolios might only be down about 3% since then until today. So there has been quite a shock taken to the market and then clawed back. And if we look at the year to date for that type of portfolio, then it's up about 2.2% for the financial year to date. So from 1 July last year through to yesterday. So far, the shock of COVID-19 seems to have been handled fairly well by the market. And it's probably, you know, it's, I think as Jono said, but it's probably a bit surprising really how strong the market has been. So Kim, in answer to your question, can we take it as a guide for how long it will take the markets to recover the previous events? I don't know. Like every event has a different recovery period. But what I would say, if you do take a long-term view, the markets do recover.
Okay. So Jonathan, what are the risks that remain for investors?
Well, look, so there's obviously a lot of uncertainty ahead, as we've said now a number of times, and in normal times, we're not even trying to predict short-term movements. So I think you'd be even more of a fool to try and predict in this current time what's obviously going to occur. But you know, the key is how does it impact me? And we keep getting back to this. You know, is this going to affect my long-term investment objectives or not? Michael's already said that if anything short-term, anything that you're looking to achieve in the next 3 years or whatever, that really shouldn't be exposed to the share market. That should be sitting away in cash or fixed interest sort of investments in any case. But longer term wealth building, you know, that 10-year plus sort of horizon there. Yes, these crises do have an impact on the portfolio for a period of time, but as this graph clearly indicates, you know, markets continue to move onwards and upwards through all these crises. And one of the dangers is that you get caught up in trying to what we call time the market, pick the when the market's about to crash or whatever, and get out before it, and then get back in at the bottom or something like that. One of the big problems with timing of the market is that it's two decisions that you need to get right, both the selling point and then the purchasing back in. And history would suggest to us that as human beings, we're pretty ordinary at getting those decisions right. The greatest outflow out of share markets always occurs at the bottom of the markets. The greatest inflow into share markets is always at the very top. That's a pure reflection of greed and fear driving us there. So not long-term investment thinking. Now, I never read anything on the 23rd of March saying that Australian shares were about to jump 35%. In fact, a prominent and well-respected ABC and Australian journalist, business journalist, wrote in early April that we should be fully out of the share market at this point. Now, if you'd followed that advice, if you had $500,000 in your superannuation, that's probably would have cost you about $150,000. If you had $1 million in your superannuation, that's cost you $300,000, and that's lost money that is gone forever. So it's very dangerous to try and get in this kind of, I'll get in and get out of the share market through these sorts of periods there. So, you know, for people that are nearing retirement or are currently in retirement now, they feel it far greater than perhaps those that are longer away from having to rely on their investment wealth to live on. But for many retirees, one of their key objectives is that they've spent a lifetime building up wealth. They've accumulated a portion of wealth, and what the plan is for a lot of them, not all of them, but a large portion that I've dealt with over the years is with their retirement savings. They wish to now preserve it for the rest of their life. And in saying that, so they're happy to draw out their 5% pension that they've got to take out each year. That will cover all their lifestyle needs and so forth. That's fine. And they also wish to preserve it for the effects of inflation, so another 2% per annum return. So they need a long-term investment return of 7% per annum in order to satisfy that goal of theirs to preserve their retirement wealth for the rest of their life, if that's what their goal is. So in order to achieve a 7% per annum rate of return, you can't now afford to have too much of your investment portfolio in that secure term deposit risk-free sort of investment there. Because as the 10-year chart showed before, that's only going to provide 1.5% sort of level of return there. Pretty low sort of level. So you need to have a greater portion of your portfolio now invested in the share market. But the key is that you still need to make sure that you've got protection there for when we go through these current periods there. So having 4 years worth of pension payments or 20% of your retirement portfolio in somewhere safe, in somewhere that is in fixed interest secure part of the portfolio, that allows you to do exactly what's needed during this period. You can still draw down your pension, but you're drawing it out of a secure part of the portfolio. You're not having to sell shares at the wrong point in the market. And that is the key to preserving wealth over long periods of time, not selling shares at the low points in the markets. And so for those retirees, as long as they've got a good portion of and that's about, as we've said, about 4 years worth or 20% of the portfolio sitting in this secure part of the portfolio, then that's generally enough time to get through these periods, as Michael pointed out.
Okay. So Michael, are there any government changes that we should be aware of?
Yeah, there are some in the space that Jono and I sort of deal in. There are some significant changes that have been announced, and largely to do with superannuation. You can see there that the minimum super pension obligations have been halved for 2020. And now this announcement was made fairly late. I think it was might have been early May. So people didn't really have time to halve their pension payments from their super because they'd probably already taken 10 months worth during the year. But anyway, to the extent that people could reduce their pension withdrawals from their super funds, and certainly for 2021, you know, they have the opportunity to reduce their pension withdrawals if they wish and still meet the minimum obligations of 5% or 6% or whatever it might be. So the 6% become 3%. And what we're finding is many clients that are in retirement are actually spending less money, or many clients in general are spending less money. They're not going on overseas trips at the moment. I mean, they can't even go to Queensland at the moment. So certainly travel costs have gone down. Working from home, you know, people seem to be, you know, saving money and not going to restaurants so much and that sort of thing. So if people can afford to draw less from their investments to maintain their lifestyle, then that's great. That's something that they can do. And I sort of look at that as a way of, one way of putting extra money into your investments or into your superannuation is to actually draw less out, if that makes sense. The other thing there is I'm probably not such a fan of, but that's the early access. If people's working income or their working hours are reduced by 20% or more, they can apply to their superannuation fund and take out $10,000 as a tax-free lump sum, you know, this side of 30 June, and then also do it again the other side of 30 June, so in the 2021 year. Some people get a bit fancy with this. They're taking it out and then putting the money back into super as a tax-deductible contribution, you know, and that sort of thing. But as I said, I'm not a big fan of this one. I think the money, if you don't really need it, the money's better off sitting away in your superannuation, bubbling along at the you know, for the next 10 years or 20 years or 30 years or whatever it is until you need to access that money, if you can afford to do that. And then we've got a whole heap of other changes of government changes, business changes. We've got well, and personal as well. We've got Job Seeker, and then we've got JobKeeper. We've got instant asset write-offs. There's a whole raft of stuff, which I know our tax guys have been going absolutely bonkers over this stuff, and they've been doing webinars, and there's a heap of information on our website for people that are interested in those sort of angles. But yeah, it's been a very busy part of government policy and you know, and advice and taxation policy.
So Jonathan, 30th of June is nearly upon us. What should we be doing in regards to superannuation planning?
Yeah, this is changing each year, obviously, with all rule changes that the government introduces. But I remember a time when putting additional amounts into super was really only considered just pre-retirement sort of thing. Now, superannuation's actually been used, number one, as a tax minimisation strategy, and the second benefit of that is building up wealth for retirement. And I think just particularly the last couple of years, with negative gearing is probably no longer the go-to strategy for reducing your personal income levels. And obviously with the lower interest rate environment, it's not so negative anymore. And probably also, I think the Labor government proposed changes now a couple of years ago in regards to looking to cease negative gearing investors. That probably scared a few people off as well. So look, I think superannuation is now becoming the main source for people to actually claim a large tax deduction in their personal tax returns there. So for instance, if someone's earning $150,000, they will have the $15,000 compulsory SG contributions going in on their behalf, but they're still allowed to put in an additional $10,000 into their superannuation fund and claim up to this $25,000 personal concessional limit or personal deductible amount there. So that's a 39% tax deduction, which is $3,900 on 10 grand. That's a significant tax saving for the individual, and then the super fund pays its 15% tax on the contributions. This year is the first year where you're actually able to carry forward any unused cap from the last financial year. Now, in order to do that, your superannuation balance must be under $500,000 at 30th of June 2019. But if it was, and in that example I just gave there, if that person earning $150,000 hadn't used up that extra $10,000 last financial year, they could in fact put that into their make that contribution together with $10,000 available for this financial year, so $20,000 in total they could make as a personal contribution into their super fund and claim that as a tax deduction in this current financial year. And that's able to be carried forward for up to 5 financial years, as long as the superannuation balance is under $500,000 in the prior 30th of June year. So that could be a really effective tax planning tool if you knew a couple of years down the track you may be selling a property or shares or something like that might have a fairly significant capital gain. You can offset that obviously with these carry forward deductible contributions that are in place there. Probably, and I guess the other change that again that's now been around for a couple of years, but when the government announced that $1.6 million would be the pension cap for people, I guess in some ways it kind of set a little bit of a target for people to say, oh, well, if that's what the government will allow us to have as a tax-free pension, why don't I try to build up a super balance that will reach that, if not exceed it? And if you do exceed the $1.6 million, that's fine. So let's say at retirement you had a $2 million superannuation balance. What it simply means is that only $1.6 million could actually go into the pension, which is the tax-free earnings, the tax-free pension withdrawals that are coming out of it, and the remaining $400,000 of your super balance would stay in the superannuation account, which would continue to be taxed at the 15% tax level there. But in order to build up a $1.6 million balance, or for a couple, $3.2 million, you'll probably need to make additional contributions above those 25K concessional ones. And this is these non-concessional contributions, or non-deductible. You don't receive a tax deduction for putting these sums in. And that's up to $100,000 each per annum. Now your super balance needs to be under $1.6 million at 30 June 2019 in order to make a $100,000 contribution into your super fund this financial year. If you were looking to utilise what's called the 3-year bring forward rule, where you're putting $300,000 into your super in the current financial year, and then no non-concessional contributions for the next 2 years, you've got to have a super balance under $1.4 million at 30 June 19 in order to be able to do that for this financial year there. So for those people who are looking to put in sort of the non-concessional, the larger amounts to really give their super a real boost to try and increase it, those larger amounts are available. That's typically the point, but also where we do quite a bit of planning, because you're typically moving assets from one structure, either in your own name or perhaps in a family trust vehicle or something like that, into superannuation. So that typically is realising capital gains when you're doing that. So it may well make sense to, in fact, finish your work, still perhaps have a couple of years where you're able to continue to contribute into superannuation and be making those larger contributions at that point, when the capital gains are not going in on top of your personal employment income. You want lower years if you are realising some fairly hefty capital gains.
So, Jonathan, what is the deadline if you would like to make a personal contribution directly to your fund to use any of the unused 25K cap from last year?
So the contribution has to be made before 30th of June 2020 if you wish to claim the deduction in this current financial year. So you don't actually have to let the super fund know of what the deduction sum would be, but the contribution must be into your super account before 30th of June. So you need to know, obviously, what's the unused portion from last year. So you take whatever the employer contributions that went in your 2019. You can see that obviously all on your 2019 statement. Whatever those employer contributions total, you take that away from the $25,000, and the remaining sum is your unused portion from last year.
Thank you. So Michael, I just briefly, due to time is running away on us, and I know we've got a number of questions to answer, but just especially at this time, what other personal financial issues should we be considering?
Yeah, well, there's always plenty of issues, and even what Jono was talking about there, the superannuation planning, the limitations now on being able to put money into super, like the small size of the caps and so forth. And so we're finding we're talking to clients a lot more, Jono, on using companies and things, or family trusts. Yeah, I know that forms a big part of the advice that we do give. Jono, do you want to give an example of where we might use a company, for example, as an investment vehicle? Yeah, well,
companies are more for obviously the larger, when there's a really large portion of wealth to use to invest. Sorry, and probably typically that's $5 million plus sort of sum, where we're trying to really just cap that income at the 30% tax rate, rather than it being taxed to the individuals at the top 47% rate for them. We're utilising family trusts because of the limitations that came in with superannuation a number of years ago, and large amounts of wealth just really can't now all go into the superannuation environment. It would be ideal at retirement to have most of your wealth in there, but if whatever amounts that aren't in the within superannuation at retirement, the family trust is probably the other structure that we're tending to use quite a bit.
Yeah, because financial advising used to be fairly simple, really. As you approach retirement, just get everything into superannuation. Like, there were no limits at all on undeducted or tax-free contributions, but that certainly changed some years ago.
Mm.
But yeah, using these structures is important, and that leads Kim to one of the reasons why we use companies and or family trusts is to help perhaps with estate planning of people. And we've been having a lot of discussions with clients around estate planning. I mean, people are probably feeling a bit mortal at the moment with all these, the world health crisis and so forth. It always takes something like that to get people to really focus on their mortality and their estate planning. So estate planning's become you know, certainly a big topic of conversation, and it's where you can do a lot of good. You know, there's a lot that can be done to ensure your estate goes to where you want it to go, and also that it flows in a relatively seamless manner, and you know, trying to get it in a tax effective manner as well. But there's a fair bit around ensuring that those things happen, you know, when people do pass on. And John, I think the other thing we've been talking a fair bit about is insurance with people.
Yeah, I think they're the two big areas where generally when we meet with people, even if everything else looks pretty okay, super is all under control and all that sort of thing, it's always estate planning and insurances that tends to be the area that we can just people just don't have it quite right with it, and often with the insurances side of things, it's more of a false sense of security, I think, that often occurs with this automatic cover that's in place in a lot of our superannuation policies, whether it's $100,000 life cover or some level of 2 years of income protection cover or something like that. You know, whereas simply if you've got a large amount of debt, you have young dependents, you need to have appropriate cover in place there. And so I always just, you know, very quickly saying income protection is really always something that should be held in your own name. It's tax deductible. It's generally cheaper than insuring your $40,000 car. We always make sure we've got all our goods insured, yet insuring ourselves the millions of dollars of futures earnings that you do have all the way up until age 65 or 70. You know, not having that insured if you're earning, say, over $90,000 a year is a real risk that you're taking. And then, you know, obviously just making sure you've got appropriate life cover in place. That can be held in superannuation, tax-wise, because it probably makes most sense with that. Yeah.
Thank you, panelists. I think we will now go to Q&A because we've got a number of questions. So I'm just going to go quickly to the chat box because I've got some questions in there. I'm sorry, and this is referring to the index before. So did that index reflect just share price or does it cover returns? Given the current outlook, should we expect lower returns over the next few years?
That's the Australian wall chart, was it?
Oh, I think so.
Yep.
Yes, I'm sorry about that. Yeah.
Yep. That would have been the just the All Ords index. So that doesn't include that chart wouldn't have included the dividends, which is an accumulation index.
Okay.
Comes through it. So slightly
the dividends
flatter.
would be pretty low in that period anyway. Like you're only talking about a couple of months.
Yeah. Yep. What will returns be like for the next few years? Don't know.
Okay. So our first question in turning in our Q&A. So my objective is to take advantage of any opportunities in the market. Being debt-free, I would like to buy my first home. Is it the right time and window, or should I be looking at other assets?
I think if someone's looking to buy their first home fairly soon, then they should be hanging onto their shackles and keeping them tight and in a secure place. So that's where cash is, it's not giving you much of a yield at the moment, but it's giving you a lot of security, and that security is priceless if you're about to spend all that money on a new home. So general advice only, we are only giving general advice in this session, but likely if you've got a short-term investment horizon, go more secure than less.
Okay. So Nicholas Baum made the point in The Spectator last week that nearly 60% of business and individuals are now in some way reliant on the government. As this is territory they will be reluctant to give up, what concern should we have for this alarming fact going into the future?
Yeah, that is alarming and no doubt true. But I think it will be interesting to see how people get weaned off the government money trail. I think in October when people come off the JobKeeper program, it will be very interesting to see how many businesses are back up and running fully and able to get by without the JobKeeper payments and then the other incentives and so forth. Personally, I'm not a big fan of people being reliant on the government. we work a lot with self-funded retirees, and I think self-funded retirees deserve to be applauded for following rules, earning money, putting money aside when they could have spent it, but putting money aside to fund for their own retirement and have little reliance on the government. I think the more we encourage that, the more that happens, the better. And so this 60% number is alarming, and it will be a key factor to see how people come off that over the coming months. And hopefully they will. Hopefully the economy will rebound strongly, such that people don't have to rely on that.
So from that rebound, Michael, because one of the questions here is, what is the view on the current rebound? Is it sustainable?
Yeah, well, that's, we've talked about V-shaped, we've talked about W-shaped and WWW-shaped rebounds. Jono, I don't have a view on that. Do you have a view, like how sustainable?
Look, and that's I guess what we're trying to say, that don't get too caught up in trying to predict, what will go on in the short term. I will say that I'm very glad we live in Australia and obviously New Zealand with all this health crisis, because obviously we look a hell of a lot better than the rest of the world where it's at. Yet share markets wise, we're actually not one of the better performing share markets on a global basis, which is surprising to me. But so I guarantee you, if a flare up occurs again and we do have to go shutting down the economy again, the share markets will fall a lot during that period. So it's very uncertain through this period.
Okay.
Yeah, it is unsettling, and there are a lot of people, Kim, who are actually doing pretty well at the moment. Like their jobs been maintained, their income's been maintained. They've seen no drop in income. Some, like a lot of people have, but some haven't, and their expenses have gone down. So a lot of people are actually finding that they're flush with extra money at the moment. And looking
so if
for
one
things
was
to do
current investing into default super portfolio, is now a good time to put it into high growth if you're not looking to retire for 10 years plus?
I'll just make a comment on that. The default super with particularly many of the industry funds, in fact, is now virtually high growth. There's been a big change over the last few years with these interest rates coming down. Look, Host Plus made headlines earlier during this crisis here with a shortage of cash. The person that runs the Host, well, the investment decision maker at Host Plus, last November was out there saying that our balance fund has zero cash and fixed interest investments in it because there's zero return for it. Caught them short, obviously, during this period there, but that was their balance fund. So balance funds, in fact, have moved to be quite aggressive for a lot of the default superannuation options over that period. So whether you go to high growth or stay in the balances, I'd be surprised actually if there's too much of a difference between when you have a look at the underlying investments between the two. The big problem with switching out of the default option with your employer super is that you're losing the lower fee option. Most My Super products have a very low, whether you're with a retail fund or an industry fund or whatever, they're all very similar sort of products, and they have a very low fee in place there. So once you start making choices with your investments, you're moving into a higher fee option with it, and it may not be for a significant investment benefit there. But obviously, always check what it is. You receive your annual statements, and it should show you what the underlying asset allocation is. But I'd be surprised if the balance funds weren't somewhere up around that 80% level in shares at the moment.
Shares or infrastructure. Yeah. Actually, just a further point there, Kim. I think we've been saying to sort of stick to the investment strategy, and if you are going to do a large chop and change to your investment strategy at the moment, we're tending to do it in chunks, like not putting a lot of money into the share market in one go. You're probably spacing it out over monthly installments just to sort of ease things in. I mean, if you did that superannuation change, if you did it on the 23rd of March, you'd be a superstar right now. But who's going to, who's going to pick that day as the time to do it?
So what, using investment bonds, do you feel is instead of superannuation is better?
The investment bonds, yeah, they can be all right for some purposes. They're good for estate planning purposes. They can give you some certainty with where your money goes upon death. I always look at investment bonds. It depends a bit on the investment options that they've got available to them. Some of them are becoming quite good, I think. But people sort of think of them as almost as tax-free investments. They're not, certainly not tax-free. They're tax paid. So 30% tax is paid within the bond as it goes along. And so then after 10 years, it comes out, you know, so-called tax-free, but it's only because it's paid 30% tax along the way. And in that way, it's a lot less tax effective than superannuation. And often there are other ways of mitigating tax without turning to investment bonds. But yeah, they can certainly be valuable for some situations.
Okay. So for those investors with a higher proportion in cash now, what would you suggest is their strategy right now if cash holding is not critical to meet current outflows or expenses?
Yeah, if they did want to get, again, general advice, but if they did want to get a bit more into the share market, that's where I'd probably be looking to do it in stages, spread it out over time, because it is volatile at the moment.
So bearing in mind the virus is spreading in intensity, do you think the market is reflecting the real economy? And will the Australian market differ from the US and the UK markets?
I guess that's the surprising part to me, that the Australian market, given our situation with the virus, where we are a hell of a lot better than the rest of the world, yet our market compared to the US market has underperformed that. Surprises me a little bit, but perhaps it's more of a reflection of the, as I said, more of this tech sort of theme that's certainly very much grabbing a hold of the share markets at the moment there. But although the share markets have gone up quite a lot, there's still a lot of volatility in the markets around. The movements are very big, and so that's why we're saying we wouldn't. They have, if there's any more significant flare-ups, and if they have to shut down overseas countries and states and all that sort of thing, the share markets will reflect that very quickly.
So if one had to split the portfolio into a well-diversified one, what principles would they follow for the short term and long term? For example, 50% property, 20% shares, 10% cash?
We would tend to go more on Australian shares than the high proportion in Australian shares than property generally, partly because of that yield in the Australian shares, and then those tax credits, those imputation credits, are very valuable as well. But it's yeah, it's horses for courses. You know, people need to consider their situation and or get advice on their situation. It's a bit hard to answer that question, Kim.
There is no one general asset strategy that's suitable for everyone.
No.
So I'm the age of 66, paying $23,000 a year in life premiums. Should I continue with this?
I'd be getting our life guy to do a review of that very quickly, very soon.
Should people be investing in the index via ETFs rather than seek investment advice?
ETFs are good. It's the exposure to the asset class that's the key. So I've got no problem at all, particularly when you're just starting up portfolios. You know, it's a cheap way to get exposure to the market. An ETF, it's a well diversified fund there. There's a lot of talk that fund managers are not able to beat the indexes. Therefore, why do you you know, use fund managers, sort of thing? You know, we've been in this game for a long time, sort of thing, and there's certainly a very large portion of, and even if it is 50% of the fund managers, it's actually not all that difficult to find those 50% of the fund managers who generally do outperform their respective indexes over longer periods of time. Not everyone will always beat the index, but generally over longer periods of time, you know, we are able to find the managers who do tend to outperform their indexes. It's only by a little bit, you know, 1 to 2% per annum, but it adds up. And that's after fees, those outperformance numbers there. So We believe in active management, but I've got absolutely no problem at all with people starting up ETF portfolios.
Okay. So is it wise to temporarily increase my superannuation pension payment in order to invest in technology upgrade for the family home? So as long-term cost of living are reduced, that is retrofitting solar batteries, etc.
I guess that's a financial analysis to do. Does that person think that they'll save more money than what they would earn, if the money was left in the superannuation fund? I guess that's what that question's coming down to. But yeah, certainly reducing future costs is a good thing to do, as long as it doesn't cost you too much to do it.
Mm. So going back to that ETFs, does the average person pick certain stocks or use managed funds ETFs? Which would you recommend?
Actually, I'll answer that one. I'd say the average person doesn't do either. A lot of people just don't get an investment portfolio happening, and I think that's a real secret to accumulating wealth, is to actually have somewhere to invest the money. Now, people have got superannuation by default, whether they want it or not, and that is investing in, perhaps ETFs, managed funds, perhaps some direct shares, although more than likely managed funds. But most individuals don't really address this issue and start accumulating money and putting it away and having an appropriate place to put it away to build up over time. And it takes a long time to accumulate wealth, unless you inherit well and you inherit young, or you build a business that you can sell for a lot of money. For most people, developing wealth is a long-term strategy.
So we've got one last question. Given the current climate, do you feel job seeker, job keeper are just creating a false economy? And will we eventually lead to another market dip when these schemes come to an end in September, October this year?
I think that what they've done is they've cleverly enabled businesses to hibernate. They have cleverly targeted where the main pain is, and allow businesses to become still, but then start to rebound. Like, I'm starting to see the same people, same faces in cafes and things around town here, where employees have been kept on tap and they have been able to come back as the businesses are starting to come out of this. So it feels like a false dawn at the moment, but I do hope that businesses will be able to regather their steam and get back to where they were. How successful that will be, I don't know.
Okay. Jono, have you ever considered a career in modelling on TV?
No, it would be as successful as my teaching career.
Yeah.
Or your Lego building.
Yeah.
Love that story. Look, we are a little bit past time, so I think that we'll wrap up our webinar here. I'd like to thank our panellists, Michael Hutton and Jonathan Philpot. I think they've been extremely informative today. I'd like to just raise this poll just quickly while I've still got you here. I'll just put this through and launching the poll now. If you would like someone from our panel of experts to contact you, and that there is a number of issues there in terms of superannuation, personal insurance, estate planning, personal debt, building wealth or retirement planning, if you'd like to enter into that poll for me now, and I'll just let that run. Thank you again. Panelists, did you have any final words of wisdom for our guests today?
Yeah, no, just stick with it. Don't get too anxious. Don't read the daily papers too much, or watch the nightly news too much. When it comes to investment markets, they tend to really focus on when things go down. They tend to miss it when markets go up. So don't get yourselves too anxious.
Yeah, and stay safe, stay healthy, and we'll eventually get through this crisis as we have with all the others in the past. We'll move forward.
Thank you so much.